Yeah, we'll be starting the webinar now. If there's any glitches, if there's any sound issues or any video issues, just shoot me a message on the chat. We have somebody monitoring the chat for us, so they can let me know. Uh, and if there's any other issue apart from voice and video, just pop that in the chat. Any questions along the way, feel free to pop them in the chat as well, and I'll be happy to answer as I keep reviewing them every few minutes. I'm going to share my whiteboard with the presentation. If you have any issues with the whiteboard, just let me know. I know whiteboards can be a bit faulty here and there, but yep, just starting them now. All right, if everybody can see the whiteboard, just show me a thumbs up. Perfect, perfect, perfect. Right. You have this last minute add-ons over here. Perfect. So welcome everybody to the webinar. We'll be going over portfolio building. Our session for today is about portfolio building 101, starting your real estate real estate investment journey in 2025. So introduction, half of you know me already, but a quick introduction on who I am. My name is Rahul Arora. I'm with eXp Realty. I have over 10 years of experience working in Toronto and GTA. We help clients build wealth through strategic real estate investments. As a lot of you know, our main goal for real estate investments is building portfolios for our clients. I did the same for myself as a new immigrant when I came here. I started my real estate journey with one single property and scaled my portfolio through smart refinancing strategies and timing the market. So I grew from one property to six in the last decade. We're generating over $200,000 of rental income every year and all through strategic planning. So just a quick timeline. 2010 is when I came to Canada. 2012, we bought our first home. You'll be surprised by that number, but 350 was an actual price for a semi-detached home back in 2012. We bought that with minimum down payment, saved a bit more. 2015 is where I started my real estate journey and also my investment journey. I bought an investment property in Toronto around 600K, again with minimum down payment. In 2017, I renovated, added a legal basement unit, then using the Burr method, 2019, we reinvested, purchased a third property using the refinance strategy. 21, again, leveraged equity from one of my properties, acquired another investment. 23, we came together for a joint venture for investment with somebody. And as of now, 2024, 25, I have about six properties under my portfolio, and they're generating good rental income and covering most of my basis for the mortgage. So that's all about me. For today's session, we'll go over certain points on how to buy your first or the next property with just minimum down payment. A lot of people think you can buy only your first property with minimum down, but that's not true. Even your second property, if it's a primary residence, you can buy with minimum down payment. And with new rules in 2025, you can actually go up to 1.5 million instead of one. So leveraging the new rules and the first time buyer incentives, we'll go over them as well. And how to leverage your home equity, your current home, if you've bought it a couple of years ago, how to use that equity without selling the property, using the refinance strategies and get access to that tax-free cash money. And we'll also go through how to build long-term wealth through strategic real estate investments. Strategic is the right word here because wait, just missed out. Yeah, because you need to make sure your investments are very strategic in terms of growing pockets. Make sure you get the investments right in the first place. And we'll also go over why 2025 could be the best time to start investments. So looking at some of the market trends and why now data, when we look at real estate numbers, we look at the overall picture. Let's say what's happening overall in the GTA. How's the appreciation like? How's the rental market like? But it's a bit more detailed than that. You need to go and access individual pockets to see how the market's doing. I'll show you some examples that will give you a clear idea. It just drags me back all the way down. I don't know why, but okay, there we go. So when you look at real estate market trends, we start at, let's say, a GTA, all communities, all property types to see what's happening in the market. If you see in the last 1 year, the market has been volatile. Our 1 year value change is about 2.3%, which is not great for a growing market. We expect somewhere around 4 to 7%. Last 5 years, if you see, we're sitting at 29%, even with the dips happening in the last 2, 3 years. Last 10 years, overall GTA market, all property types on an average have gone up in value almost 100%, which is doubling the value. Now let's look at different property types. So now all GTA, all communities, the detached house, last 1 year price change, it's pretty much break even, not much in there. Last 5 years, it's up by 40%. Last 10 years, again, 100% increase in just the detached segment all around the GTA. Now, when you look at semi-detached, very similar to the detached market. A lot of people think detached grow much higher than semi, but again, depends pocket to pocket. If you look at an average value, semis and detached are going neck to neck for the past 10 years. And then we come to freehold townhouses. You can see in the last 10 years, freehold townhouses have grown more than some of the detached and semi-detached houses as well. So not any house type property can be said as a great investment. It just needs to be looked in terms of neighborhood as well. Condos market overall, if you see for the townhouses, condo towns, they're pretty much standard, no increase in the last year. But again, last 10 years, they've doubled their prices. Last five, a healthy growth of 29%. But just the condo market, as we are all aware, the condo market is slightly down compared to last year. So we're down by 2.4% on an average, 11% plus in the last 5 years, and almost 90% plus in the last 10 years. The condo market has seen good growth over the years as well. Now, coming back to some of the local data, like micro markets, and how these how these markets change compared to the overall analysis. So 1 year value change for Parkwood's Donalda Pocket in North York, just for the detached segment in the last year, is 18.5% higher than last year. In a market where everybody's saying prices are falling, markets crashing, this change is specifically neighborhood dependent. These values of 18.5% are huge because this value, the median average price in this neighborhood is roughly about 1.7. So an 18% increase is a hefty sum of money. In the last 5 years, it has grown 39%, and 10 years again doubled its value. Now, again, in North York, if you look at a different pocket, which is Yorkdale Glen Park area, you'll see for the detached house, the values have actually gone down by 3.1%. So again, specifying the value of the neighborhood has a lot of impact on the house values as well. The median price in this neighborhood for detached is still 1.2. So it's not cheap neighborhood. In last 5 years, it's only seen a 15% growth. And in last 10, it's about 60%. So much lower than the average GTA price change in the last 10 years. Now coming to a different pocket in North York, St. Andrew Winfield's, very posh neighborhood, very expensive neighborhood. You can see the median price point is sitting at 3.6 million. And even this neighborhood at this price point has seen a 22% in the last 1 year. This neighborhood was practically stagnant for the last 3 to 4 years. You can see in the 5 year data, only 25% overall in 5 years, but 22 of that is just in the last year. Overall 10 year is still sitting at a healthy average of 100%. Now, coming back to condos in North York, again, certain pockets act differently than others. So Bayview Village, down by 1.5%, but last 5 years, a healthy 3% growth per year. So looking at 15%, last 10 at a healthy 91% growth. Same pocket in Willowdale West, the values have dropped even more than what Bayview Village has dropped. So Willowdale West is considered a much better pocket than Bayview, but again, these market anomalies will happen, so you have to monitor the data very carefully to analyze which pockets you want to invest in. Now, coming back to the favorite city for everybody, Brampton. If you look at all properties, all community types, the value in the last year hasn't changed much. It's about 0.5% lower than last year. But in the last 5 years, all the type of properties in Brampton have grown by 30%. In the last 10, 120. A lot of this is due to a lot of new immigrants were preferring Brampton as the preferred city when they first began. So that's why the last 10 years and last 5 years have seen healthy growths there. But now, if you look back at different communities in Brampton, let's say for the Northwest section, the detached house has grown by 0.4%. Last 5 years, a healthy growth of 40%. And the last 10, a very healthy growth of 133%. So this means uh, overall Brampton market might be saturated or might look that it's going down, but certain pockets are still performing better. And the average value for detached is at 1.2 over here. Similarly, if you look at condos, the Queen Street, which is very popular, is down by 4.7% in the last year, but last five was 23% growth. And in the last 10, it has seen 136% growth. Let's look at Mississauga. This is one of the favorite cities for a lot of people. In the last 1 year, this has seen a 1.9% increase in prices. Last 5 years, about 30, and the last 10 at 100% price increase, which is average with the city. But again, certain pockets in Mississauga, like Clarkson, is growing by 4.6% in the last year. In the last 10 is a very healthy 123%. Well, Mississauga city center is considered to be like the most popular condo market, but if you look closely, the last year value change is at 1.7% downwards trend. Last five is very steady at 15, but the last 10 years were quite good for the area at 111%. That means the condo market is getting saturated in Square One neighborhood. You can see the values not moving much in the last 5 years. The graph is pretty much stagnant where it left off in 2021. So that shows the neighborhood has kind of hit the cap there. Okay, so if you see Bronte, we were there. Last 10 years, it has gone up by almost 175%, which is massive and doing much better than the average Oakville neighborhood. And if you see the price point in this pocket, it's at 1.8 million. So that 26% per year is still very healthy growth. Now, a similar pocket again for detached homes, West Oak Trails in Oakville. Even in a high competitive market such as Oakville, 1 year price change is down by 8.4%. Last 10 years is at 92. When you compare that to Bronte East, it's almost half of that. So looking at these neighborhoods, you need to ensure you follow the right pockets to get maximum return on the investments. And recently, you've seen a trend where a lot of builders are building townhouses, stacked townhouses, and condos in Oakville, but the data reflects otherwise. The demand for condos in Oakville is really low. The values in the last 1 year have dropped by almost 9%, and last 5 year still decent at 23, and the last 10 at 89. But this shows condo market is not accepting Oakville as a city, so you can't see a lot of growth in there. Uptown Core is another very popular pocket in Oakville. Last 1 year, they've dropped by almost 16%. Last 5 years, it's only 13% price increase, which is very nominal for a city like Oakville. So, depending on which pockets you want to invest, these micro data will help you analyze those properties very closely. Now, coming back to the webinar, I'm going to zoom it back again.
So Rahul, how reliable is this data, and does this represent a pocket of houses, or those which got sold, or it is beyond that as well?
Yeah, no, good question. So this data is actually from the MLS. This is pretty much accurate. I would say about 95, 94% accuracy, but gives you a good overview of the pocket. But when you're buying, you have to even go deeper than the pocket and look out the data for the streets and the couple of streets next to you. So
Mm-hmm.
especially in Toronto, every street will differ very aggressively. Or in Oakville, maybe a pocket will remain steady, whereas in Toronto, that pocket will not remain steady. Let's say for Cabbagetown in Toronto, one street will be selling at about 1.8, 1.9 million, but the street behind that will be selling at 950, 100,000, oh, sorry, 950 to $1 million. So that when you're buying these properties, this neighborhood view gives you an overview example or overview data of the market, but you got to go even deeper when you're finalizing your final property.
Mm-hmm. Okay.
Perfect. So yeah, we'll get back to questions again. Just trying to continue here on the section we left at. So that's how market trends and the data and the numbers are important when you're buying your first or your investment property. It gives you access to see how the neighborhood has been performing. And then again, certain neighborhoods will have lower growth in the last 1, 2 years. But if there's major changes in that neighborhood, such as a new Costco opening up or a new transit line coming in, then that those neighborhoods will grow even better down the line. So you have to look at that larger outlook for those neighborhoods as well. So now understanding what equity and leverage means in terms of real estate. So when your property appreciates, the value over time builds your equity. And as your property appreciates, you keep paying down the mortgage. So the difference between the mortgage and the current value of the house is your equity in the property. And now there are certain ways you can leverage this equity. Let me just start the video. Okay. Sorry, I forgot my video was turned off. Okay, so there are certain ways you can leverage these equities. So your property appreciation plus whatever mortgage you've paid down becomes your equity growth. And this is what leads to future investment potential. So if you, let's say, bought a condo back in 2016 worth 500K and now it's worth 900,000 and your mortgage left in that condo is less than 300,000, your net equity in that condo is sitting at 600,000. But you cannot pull all the 600 out at the same time without selling. So there are certain options we look at is how you can leverage. With 80% loan to value, you can refinance that equity from the current market value, and that becomes tax-free cash money in your hand, which you can use for investment. So we'll give you an equity assessment worksheet at the end of this webinar. So if somebody has a question.
Hey Rahul.
Hey,
Rahul, I want to ask, as a normal consumer, how do I know that which neighborhood I should buy in or which neighborhood has a potential growth? As a normal consumer of real estate, I don't know which neighborhood to select.
yeah, no, great question. Best answer is talk to your real estate agent. They know what neighborhoods are growing. Find the right agent that works in your interest, and they'll help you guide you in terms of selecting the properties. Yeah, there you go. Ashish got it right. Uh, there's another question. Are you sharing the recording? Yes, we will send an email. Probably take some time for the recording to pop up, but we will send an email to all the attendees with the recording for this video. All
Perfect,
right.
Rahul. Makes sense.
Thank you. So yeah, we were at the leverage section. So that leveraging your property to buy multiple properties is where you can expand your portfolio without using a lot of your cash all in one property. So we'll send you those worksheets. You can calculate how much equity you have right now. And if you want to work around it, give us a shout, reach out to us, and we'll help you out narrow it down. So there's been certain changes in the mortgage market right now. 1 second. Somebody trying to come in the webinar. Okay, let me see. Bunny, if you're in the chat, can you let the other person in? Just send me a text. All right. So buying with minimum down payment, these rules have changed in the last couple of months. Now you can stretch up to 1.5 million with minimum down. And the added bonus is you can stretch your amortization all the way to 30 years instead of 25, which was the rule before. So that gives you leverage to minimize your down payments. And if the house is slightly over that threshold of 1 million, it gives you the freedom to go up there without putting down 20% down. And you can leverage government rebates for first-time buyers, such as RRSPs, their first-time home buyers account, or the first-time buyer incentive, where government uses shared equity mortgage program, which I think is worthless for Toronto, so I don't even want to discuss that. But yeah, there's certain options for first-time buyers out there. Now, looking at a case study for this is for one of our clients, which we started working in 2016. We purchased the house for them with minimum down payment in Mississauga at about 700 and change. 2020, we refinanced. We kept their first house in investment, moved them into the second house. Then we had leftover funds from the refi. We bought them a smaller condo the same year. So from one property in 2016, they were able to get into three properties by 2020 by just using the refinance tool. So I'll show you that example right now, and we can go over the case study. Let me just open up the case study. I'm gonna zoom in. Let me know if you guys can. Can you guys see the case study?
We'll see it.
Yeah.
Perfect. Perfect. All right. So this is for one of our clients who started working with us back in 2016. So this case study is this is an actual example. Nothing's made up here. This is actual. The numbers are accurate. This just demonstrates how strategic refinancing combined with just investment, right investments, and proper enhancement to a property can effectively expand anybody's real estate portfolio, leveraging existing assets to acquire additional properties and then generating multiple income streams, and at the same time creating a generational wealth for you and your family to pass down to. So let's get back into the details. Our initial purchase was in 2016. Market wasn't crazy. We were able to find a detached home in Mississauga for 700,000 at minimum down payment of 45,000. Our mortgage amount, including the CMHC fees, was 681. Interest rate at that time was very similar to what it is today. We were at 3.85 for 3-year fixed. Amortization was 25 years, and approximate monthly payment for them was about 3,500. I'm just going to give you an overview of the mortgage payments. I know a property has a lot of other expenses like taxes, utilities, maintenance, but you'll see why I'm just taking the mortgage number for now. It's for easier understanding. So, market in 2020, the market was getting better, the prices got better. The property estimated value was at 955,000, which is estimated about an 8% growth per annum. If you look at the data I showed before for the recent trends, that's for the last 5 years, looks at about 35-40%, which is a great number for a house in Mississauga. The remaining mortgage balance was roughly 600,000. We were able to refinance 80% of the loan to value. So 80% of 955 was 764. And minus the current mortgage they had, we were able to get $164,000 in cash. And because now our LTV was 80%, we were able to refinance the amortization for 30 years instead of 25. And the interest rate at that time was about 2.9%. So the new mortgage amount was 764. The cash out amount was 164. We spent about 50,000 in renovating the basement, making it a legal basement apartment. They have so they also had 75,000 in savings, which obviously we used for further investments. So the total cash in hand after making the renovation, after the refinance, was 191,000. Now let's see how we use this to expand the portfolio. So the first property where they were living in, when we made the basement, we made it a rental property. The upper portion, they were getting $2,600 in rent. The basement was getting 1150. Total cash flow was 3750, and their mortgage payment, because the amortization was stretched to 30 years, was $3,180. They were almost netting $600 cash flow on the mortgage. Now, we used the cash flow plus the refinance money to invest in a second property. It was again a duplex home with a basement ready to go in Mississauga, a detached house. We were able to purchase that for 995 with minimum down payment. They were able to buy this second house with minimum down. Okay, somebody raised their hand. Yes, Alkesh, you have a question?
No, Rahul, that was accidental.
Oh, okay. No problem. All right. So, second property acquisition, we were able to find a detached home with a finished basement, purchase price of again 995, minimum down payment because they were buying their primary residence and not an investment property. So they had 20,000 in closing costs plus 74,500 for the down payment. We were able to get them a mortgage amount of almost 948. The interest was 2.6% for 5-year fixed. Amortization again 25 years because the down payment was less than 20%. The monthly mortgage payment for the new house was 4,300. Now let's see how we broke down that 4,300 for their benefit. Okay. So 4,300 was their mortgage, 1,200 was the basement rent at that given point of time. $600 we were getting from the first property they had. So the out of pocket just for the mortgage was $2,500, which was even less than when they had one property. And they still have $96,000 in hand after using the money. So 191 they had, we put 75 towards down, 20 towards closing, and they still have $96,000. So now we use some of that. Sorry, something was gone. All right, so we use some of that to invest in a condo in Mississauga. Purchase price was 450,000. Down payment was 20%. Mortgage amount was 356. Interest rate was 2.5. Amortization 30 years. So the monthly mortgage payment at that time was $1,400. We were at about 1,650 rental income for that condo. The cash flow on the condo was slightly negative. It was 1,400 for the mortgage, 350 maintenance, 150 tax, total cost 1,900, and we were getting 1,650 rent. So out of pocket was 250, which still is a decent investment in the city. Now, coming back to 2020, situation with all the three properties, the total monthly mortgage payments on the three properties was $9,000. The monthly rental they were getting was $6,600. And total net cash flow they have to put out from their pocket. Somebody saying my video is stopping. I'll just restart it. Okay. So the monthly cash flow, what they were paying out of their pocket was $2,400 for three properties. Whereas if you remember in 2016, when they started with one property, they were paying about $3,500 monthly. So adding more properties doesn't mean you're adding more mortgage payments. It just has to be strategic to make sure the rental income's able to cover a lot of those payments. So long-term benefits for equity is again, as the property appreciates, your equity increases, the rental cash flow also keeps increasing, creating a steady cash flow and significantly offsetting these expenses. So portfolio diversification, if you own multiple properties, make sure you don't put all the eggs in one basket. Try and get into different property types to make sure your investment is safe. And if any market shows fluctuations, you are able to cope up. So now the current financials for 2025. The total monthly mortgage payment is still the same. We haven't touched the finances yet. It's $9,000. Now with the increased rent, the total monthly income they're getting is $8,150. Out of pocket has come down considerably from $2,400 to $850. This will help. They will have to go do a refinance this year with higher rates. This number will eventually go a bit higher, but again, they have room, they have potential in the properties to refinance and get some more cash flow to help them out if needed. So the rent increase over time. The first property when we rented out in 2020 was at 2,600. We just rented out the main floor for them in the last year in November for $3,000. The basement is currently sitting at 1,450. For the current house, the basement is now currently sitting at 1,550 from 1,200, and the condo is currently sitting at 2,150. So these minor increases in rent eventually help you out, even out the cash flow. The goal with all these investments is to make sure this number comes out to be zero eventually. All your investments should be able to fund your finances in terms of your primary home, your rental homes, and make sure you don't have to spend a single penny from your pocket on the mortgage. You will still have to spend money on maintenance and property taxes and stuff, but if you're not spending money on mortgage, that's a big win. That's, in my sense, that's complete financial freedom when all your investments are paying off for themselves and your primary home. Now, looking at the property growth numbers, the first property, which was estimated value at 955 in 2020. Sorry, I'm just let me sip of water. So the property sitting at 955 in 2020 is now sitting at 1.15. The primary home they bought for almost a million is now sitting at 1.22. I think it's more towards 1.25, but we've taken very conservative numbers. Uh, Third property, the condo we got just below 450 is now sitting just shy of $600,000. So total property worth is when they started in 2020 was about 2.35, and now they're sitting at almost just shy of $3 million. This just shows you the strength and the scope when the property values go up. One property going up by 10% compared to three properties going up by 6, 7, 8% gets you more leverage down the line. So it just demonstrates how strategic refinancing combined with proper investment and property enhancements can effectively expand your real estate portfolio, leveraging existing assets to acquire additional properties and generating multiple income streams for you. So this is just one example, and we've got a lot of clients we're able to replicate the same process. Again, not everybody's story is the same. Some people can use these strategies in 3 years instead of four that these guys have used. Some people have to wait 5, 6, 7 years, depending on their income status as well and the job growth and career growth. But these are all possible. None of our clients are like uh, out of the world clients or getting huge paychecks, but they're just regular clients who've saved up money with a lot of effort, a lot of savings, and they're able to grow their portfolios. All right, coming back to the webinar. I don't know why it resets. The most important section in building a portfolio are the tax benefits. People are scared for negative cash flow properties, but negative cash flow is the only strategy in the market that can save you on the taxes. And I'll explain why. So, mortgage interest, property taxes, insurance, maintenance are all tax deductible. These you can take off your rental income, and then the net income that you have is taxed. But what we try to do is we try to get maximum mortgages on our investment properties while reducing the mortgage on a primary property. Because let's say if I'm paying $5,000 every month on my mortgage for my primary, I am not getting any tax benefit. But if I reduce my primary mortgage to, let's say, 200, 2000, or $1,500 a month and take this mortgage and put it on my investment, now from my investment properties, if I'm paying, let's say, 5,000 and now it's gone up to 7,000 a month, my entire interest payment is tax deductible. If my rent is 4,000, I'm reducing 5,000 interest. That negative cash flow is actually coming off my T4. So you're still paying the same amount of money every month. It's just that you are paying less for your primary, but you're paying more for your investments. If anybody has any questions on, because I know this can be confusing at times, but if anybody has any questions, feel free to raise your hands. But this is the best strategy to keep your cash flow in your pocket and not pay the government for all the efforts that you're doing. Once you have the portfolio, four, five, six properties down the line, this might take 10, 12, 15 years, but you will save a lot of taxes. Any improvements you do on your investment is tax deductible. So even if you have to do some maintenance on your investment properties, you will save a lot of money on the taxes. Uh, so this way, you can eventually keep paying down your primary home, even if you, let's say, refi, but you don't want to do use that money to buy another property. Refi your investment, keep it to its maximum 80% loan to value, use that extra cash flow and pay down your primary. The banks won't allow you to do that if you tell them, but if you tell them I'm using the money for investments, but later you pay down your primary, they won't stop you. So that ways you can keep your primary at the lowest while keeping your highest mortgage on the investments. So, for example, if an investment property is generating $500 monthly loss on the negative cash flow, you can save more than four, $5,000 of taxes per year. All the refinance proceeds you get. Sorry,
Rahul, sorry, I have a question.
yes,
Sorry, I couldn't able to raise mine because I'm driving.
no
So
problem.
I'm just asking the question right away. Okay,
Yep,
uh, so let's say, for example, I have a two properties. Okay, and I want to push it down to my generation, like to my daughter or to my to my wife. I mean, of course, the wife intern is not gonna problem, but if I'm doing for my daughters, like so then it comes in real estate, so we have to mark an estate and everything.
yep.
And once this properties goes on to them, so their income at the time of getting these properties is becomes taxable for them at that financial year. Is that my understanding is right or wrong?
Uh, Kind of like if you, because you can't just transfer a property if it has mortgage on it. You have to transfer the mortgage as well. And anybody you're passing down a property with mortgage needs to qualify for that mortgage for the bank. If it's a completely paid off investment, then yes, you can transfer it to anybody for whatever amount you want to show with minimum like tax payments or land transfer payments. And
Mhm.
any income that's generated from that property will be taxed on anybody's name who's getting the property. So that's why
No,
for any investment properties, we want to keep the mortgage levels at the max so we can offset the rental payment that we are getting from them.
no, what I heard, probably I might be wrong. That's why I just wanted to get it educated.
Sure.
So that's the reason I'm asking this question. So what I learned from one of my friend is that let's say I have a $1 million property. Okay, so
Mhm.
I'm passing down to my daughter. So now, though whether they are selling or not selling, right? So it comes as an investment on that. For example, in by passing that year, so the property value might be 1.2 million.
Yep.
I might have paid a 900,000, and while passing on it might be 1.2 million.
Yep.
So now the balance of 300,000, right, whatever it is there, so that will come as an income to my daughter when I'm passing on this property to them. Is my understanding correct, or is it my understanding is wrong?
So When you transfer a property to any family member's name, there's a certain value we give to the property, which the amount is registered with the government. So that amount from the day it's transferred on their name, that is the base value given for that property. Any increase in value from that day will be
Mhm.
taxed capital gain. Any rental income generated from that day will be counted in their income. I think somebody's saying my video is paused.
Okay, okay. So
Yeah.
let's say, for example, if it is a 300,000 is considered as a capital gain. So on that particular year, so the 300,000 will be coming as in capital gain in my daughter's financial, or on that financial year for my daughter. Am I right?
Yeah, no, capital gain is only when the property is sold, not when somebody inherits the property.
Oh, that's where I have a confusion
Yeah, yeah. So
because
there's no taxes for inheriting a property.
okay, okay. Because I've been told that given for inheritance, so there is a tax that will come as a capital gain on that particular financial year.
If you inherit your property and they sell it in the same year, then yes, they would be taxed as capital gain because they're selling an investment, which is not their primary home. But again, there are a lot of ways to get around that as well. The components called as family trust. You can open a family trust where everything stays within the trust and not in anybody's one particular name. So you can offset a lot of taxes if you open a family trust. But family trust doesn't make sense if you only have one or two properties. Family trust makes sense when you have four, five, six properties and you're saving a lot of taxes on those ones. But for one or two properties, it doesn't make a lot of sense. The legal hassles are a lot. Uh, they're quite a bit to create that family trust and even to sell it eventually.
Okay, okay. Sorry, I diverted from the topic, but I thought to ask that question.
No
So
problem.
sorry.
No, no, that's all good. It's more information for everybody. I see Dhruv has raised his hand. Dhruv, any questions?
I have one question. So,
Sure.
to what I know, I can be wrong, but they said that the first property, which is your principal property, is tax free. However, if you have any investment properties, they are going to be taxed based on the capital gains from the time of purchase to the time when it is being passed on. Is that correct?
No, so passing on properties have different meanings. If somebody's inheriting a property, and it has a mortgage on it, then somebody cannot inherit a property with a mortgage. Somebody has to take over that mortgage. If it's a completely paid off property, you can inherit it for a very nominal fee. So they're not taxed on that capital gains part of it, but they're taxed on the land transfer part of it. When the person inheriting the property sells their property, only then they get taxed. But if the person inheriting the property actually makes their primary residence and stay in the property for a year, they will not get taxed.
So
Okay.
Rahul, essentially that means that if we, let's say, buy a property for $1 million, and 10 years down the line, it becomes $4 million. And at that time, my son inherits that. For him, the baseline will be 4 million. And whenever he sells it, let's say 5 years later, for let's say $5 million, then only 1 million will be taxed for capital gain for him.
That's correct. So they look at the
Okay.
market values for the day the inheritance has happened. And the best way to escape all this is again why we use leverage and refinancing, for example, is always have mortgages on these investments, never have them paid off investments, because till the time you have mortgages, you will be saving a lot of money from capital gains. So let's say you've okay, I think some things happened there. Let me start the whiteboard. So the idea behind keeping mortgages on all the investments is because you need that tax benefit when you're selling the property. Let's say you bought a property in 2010 for 500,000. The value for that property in 2025 is 1 million. If you sell that property in 2025 without refinancing, you'll be paying all the profits that you've made from like 500,000 to 1.5. Those all profits will be taxed at capital gains if it's your investment. But if you keep refinancing the properties every 5, 6, 7 years, your actual equity build will be less because you've always taken out cash from the property. You still have made money on these properties because you've pulled out cash every time you refinanced it. So you just kept the leverage on the banks higher, but you have that cash sitting in your bank account. Now you could do multiple things with that cash. if your mortgage payments have gone up before because of the refinancing, you can keep aside certain sum of money that you need to pay for the balance of the mortgage difference every month, every year, and use the other balance to invest in stocks, maybe in real estate, maybe in paying down a car or paying down your primary home. So that ways you leverage the bank's money and still have a lot of cash in your account without paying a lot of taxes. So these tax liabilities, I'll give you spreadsheets at the end of the webinar. You'll get an email, you'll get a rental estimator calculator, you'll get the equity calculator, and how these can improve your refinancing capabilities and also reduce your tax liabilities will be explained in those documents as well. So you can go through them. Any question, shoot me an email, drop me a text, or give me a call, and we can go over individual situations. Because with real estate, every person's need are is different. Like if somebody has refinancing because they want to invest in real estate, somebody wants to refinance because they want to build an extension to their house, create more rental income. And with the new mortgage regulations, if you are refinancing a house to build an additional unit like an ADU or a basement rental, you can refinance up to 90% of your refinance mortgage. So let's say if your market value for a house coming at 1 million before these new rules. Okay, somebody's saying video is stopping. Let me restart. Okay. So with the new rules, if you have $1 million house value, now you can refinance up to 900,000 instead of 800,000. So you get that extra leverage to make maybe let's say a basement apartment, add a ADU, add a garden suite, because that rental income will offset all the interest payments you're making on the mortgage and create your portfolio. When you look at real estate 10, 15, 20 years down the line, cash flow, yes, makes sense if you're making five, $600 extra every month. But the major money that you will make is because of the appreciations. That's why some of the pockets I had shown you before, where the growth in the last 4 or 5 years is 30, 40, 50%, those are the pockets that will eventually lead to higher return on your investments, even if you're, let's say, $300, $200 negative on the cash flow every month. Because eventually, when the property value goes up, we leverage that refinance money, keep it in our bank accounts to service the extra debt we have, but we don't need the entire refinance money to service the debt. So I give a very like recent example on what I did. I refinanced my house. I pulled out roughly about 350,000 out of the refinance money. I used 200,000 for an investment, but I kept 150,000 just as a backup in case my monthly mortgage payments. I need help to pull out money. I will use that saving bank to service my debt. I don't have to pressurize myself. So depending on the risk-taking capacity you have at the stage of life you are, you can decide how to use that refinance money. I had taken a lot of risks with refinance where I could go way neck to neck, but at this stage I want some backup. I want some safety net behind me, so I have left at 150,000. But if it was 5 years ago, I would have probably used that 150,000 and bought another investment as well. So it just depends on what's your risk tolerance and how are you planning to use that refinance money. And again, it is not a short term goal. With real estate, my advice to everybody is to hold on to the properties for as long as you can. That is where you will create generational wealth. And with investment properties, it's like any other business. It will require some of your efforts. It will require some maintenance. It will require some handling the tenant issues. But when you look back at it 10, 15, 20 years down the line, you'll be very happy that you didn't sell the property. Because I have seen the houses that I had bought back in 2010, 2011, 2012 for 300 and change and now sitting at $1 million right now. Current house I bought for a certain value, it has gone up by almost 35% since then. So these values will only get reflected over time. The markets are unpredictable. We're seeing certain dips in the market right now, but as you've seen, a lot of pockets are still seeing 20, 25, 30% growth in these markets. Karan has a question. Yes, Karan.
Rahul, I wanted to ask, uh, if I keep buying properties, how would I manage it? I don't know.
Again, good question. That's why we are here for. So we do help out with all the management issues as well. We can take over a complete management, or we can give you the back-end support to manage these properties. We've been dealing with tenants for a very long time. Uh, Once you buy a property, it takes about a few months to get used to the tenants and the tenants getting used to the landlord. But we definitely will be on your back end to give you any support you need for managing these rentals. So that's why you need a very strong team when you're getting into a portfolio buildup. If you think you can do it alone, it is not possible. I started with the same issue in 2012. I thought I could do it all by myself. I could do all the research, I could furnish the tenants, I could manage everything, but I got drained out. All these investment steps I've taken could have been much faster as well. I could have saved myself 1, 2, 3 years if I had the right guidance behind me at that time. Because those markets don't come back again. Like I missed the peak markets when the values were really great. If I was able to add maybe one or two more properties around that time of the year, my portfolio would have grown tremendously by now. But again, I learned from my mistakes, and all these webinars and all these trainings we are getting in just because you have a hand behind you to hold you through these steps. It is very difficult to navigate the market yourself. It is very difficult to analyze the data. Every different website will give you a different analysis because nobody is in these markets day in day out. We are in these markets day in day out. We know which buildings are rentable, we know what neighborhoods are rentable, we know where to spend the money in the properties to get you the best rental potential. uh, our clients have been spending money on their renovations and they're getting solid returns on it. And now I get calls from some of the people where they say, "Oh, we spent 200,000 on a property and they bought it for 1 million and now they can't even sell it for 1.1." So those things don't make sense. Like if you're spending money recklessly on a property, again, it won't give you the actual returns. We can analyze anybody, I would say, who's planning to do any renovations, reach out to us, let us know what you're doing. We will guide you. We will let you know what can get you the maximum money out of these investments. Because just spending money without thinking, making the property very personalized only for you, cannot give you the rental returns or the refinance returns. Appraiser doesn't care if you spend 200,000 just on the flooring. For him, it's just a new flooring. They'll count it as a new flooring. So be very careful in where you invest and what you invest in. So that's why you need a strong team. You need solid mortgage brokers who understand portfolio buildups. You need agents like us who understand how to build portfolios. You need property managers who can manage your properties, take care of the tenant. Anytime that a tenant knows there's somebody in the middle to reach the landlord, they'll be very careful. Whenever a tenant knows they can reach the landlord directly, they will reach out to you for every minor thing, even as such small things as replacing a bulb. When they know there's somebody in the middle who's going to take care of things, then they also get restrictive. And you got to give them some time to adjust to the rental property as well. But I can give you access to my mortgage brokers, real estate agents that can help you with showings, managing the properties. We have property managers. We click professional photos for your properties. We can take care of all that if you need. And the most important thing you need is to analyze the market, where you're putting the offer, what neighborhoods you're targeting, what is your 5, 10, 15, 20-year plan. We're not in the market to just buy you a house and sell it next year. We are in the market to make sure your one house gets you to 3, 4 houses in the next 5 to 10 years. That's what I've done with myself. That's what I've done with a lot of clients who are here on this webinar. This just shows our commitment towards building generational wealth, not only for us but for everybody we work with. And that is what I strongly believe in. I think I've had a lot of discussions with people on the webinar when you've called me home to sell a property and we've eventually not sold the property but just kept that as a rental and bought another one. That is the power of leverage, that is the power of equity, which you guys should utilize. And if you need more information, any detail specific just for your property, we are more than happy to run these numbers for you. You will get a link with a with a link to schedule a call if you'd like to. Just set up that call with us, and we'll go over those details with you. All the handouts will be provided in that email as well. You can go through them. If you haven't finished your basement yet, use those handouts to see how much it's going to cost you to finish those rental basements and how much value it's going to add to your property and to your monthly cash flow. Uh, if you want to join us for our exclusive investor list, we have off-market deals and insights that we posted for a very short group that we have. We don't want to spam anybody with emails. So if you want to get that in, send us a message, send us an email, and we'll add you to the group. And yeah, click the link on that PDF document or on the email to schedule a call with us. The floor is open for any more questions. I'm just going to go through the chats. Thank you, Abhay. Thank you for the comment. But if anybody has any questions or any concerns or any issues with the numbers I shared, Please feel free. And we have another, 10, 15 minutes. We can go over the questions.
Rahul, not a question, just a request.
Yes.
If you have done analysis on the east side as well, so that will be great because all your analysis were on the western side.
Oh, for sure. We have analysis for the east side as well. Just didn't want to barge people with a lot of data.
I
We
know.
selected only like selected pockets where most people
Sorry,
have.
yeah, just being like too much personalized questions.
No, no, not at all. Not at all. We'll send you personalized data for your pocket. Ajax would be Durham as well. Yeah, your pocket is doing actually pretty well. It's up at about I think 4 or 6% in the last 1 year.
Rahul, I joined a few minutes late, so I'm not sure if I missed that part. But how do you see the condo market shaping up in the next year in Toronto?
Yes, absolutely. So in the last 2, 3 months, we've seen the rentals move a much quicker than what they were moving, I would say 6, 7 months back. Condo market still has some room there to, like some time there to start seeing growth. In really good pockets, I would give it 8 to 9 months. In certain areas outside Toronto region, I would give them about 12 to 15 months. But we're seeing that interest coming back in condos, especially when workplaces are getting open with work from home getting reduced. And that's what we've seen with our recent rentals. I know there was a time when our rental properties were sitting in the market for 30, 40 days, which we've never seen in the last 5, 6 years. But last 2, 3 weeks, I think we've rented out 7, 8 properties, and most of these properties were not in the market for more than 2 weeks.
Yeah. No, I totally agree, Rahul. I've seen certain employers calling back employees at least 4 days a week now,
Yes,
as opposed to three, right? So yeah, thank you.
absolutely. I think that's gonna make a big impact. And if you see another aspect of it, none of the builders are reducing their prices for the new builds. And if you talk about new builds, most of the inventory that we've been getting, they they started construction 2020 to 2022. Not major construction happened again. Okay, if people are saying my video stopped. Let me restart. Yeah. So from 23 onwards, the pre-construction has come down. Almost 70, 80% projects have been cancelled within Toronto as well. So 24, we didn't see any major builders launching and starting construction. 25 yet, I don't see any plans for these builders to start construction this year as well. So most of the inventory that we'll be getting this year is from construction that started 2020 to 2022. I think we will have shortage of condos at the end of 26, early 27, even dragging on to 28. And then builders are going to start constructing these properties at the end of 26, 27, which you will see hitting the market in 29, 2030. So you'll have that window from 27 to 29, 2027, 2029, where condo markets inventory will be down considerably. And now with the new immigration changes, they've kind of really hit down hard on students. They're trying to get in quality rentals. So you would see more demand for condos than basements, especially with kids when they're coming in. Again, budget issues, nothing against them, but again, they're not able to afford a one bedroom for 23, 2400. It's barely within their range. So the new immigration policies will actually help cities like Toronto, Vancouver to get that cream crowd into their investment properties. And again, those tenants will eventually become home buyers because they are coming from a good background, good employment. They won't be your tenants for more than 3 years. And again, that turnaround of rental properties will mean higher rents every time the tenant changes, and the demand will keep growing in a city like Toronto, Vancouver. I don't see markets crashing. I didn't see rentals crashing. I think we've seen the worst already last year, early this year. We are slightly on the uprise. Last 4 or 5 weeks have been crazy for us as well. Every townhouse we are trying to buy in Mississauga, Brampton, Whitby, the multiple offers everywhere. It's not crazy. It's not 10, 12 offers, but it's still 3, 4 offers. So you're seeing people are coming back into the market with the rate cut coming in March. I think the market's going to get even better. And by the end of the year, the freehold inventory will shrink down. People will start moving back to the condos. So the overall market will see growth this year and next year.
Sounds good, Rahul. Thank you so much.
Perfect. Thank you, Saket sir. Thank you for your comments.
Rahul, I had a question about the minimum down payment.
Yes.
So I was under the impression that that applies only for your first property. But as I understand it, even for the second property, it would apply as long as it would be your primary residence. Is that right?
That is right. So it could apply to your second, it could also apply to your third property. So every time you're buying your property to move in, you can qualify for
Mm-hmm.
minimum down. But again, at one point of time, sorry, somebody says my video is stopping. At one point of time, if you make building a portfolio, paying CMHC again and again doesn't make a lot of sense as well. So up to two
Mm-hmm.
property, it is okay. But anything beyond two, I would highly recommend do
Mm-hmm.
20% down because that helps you uh, use that refinance strategy as well. Because since banks only refinance 80% loan to value if you're not adding a rental basement or an ADU, uh, putting that
Mm-hmm.
20% down increases your potential to refinance in the next 2, 3 years.
All right. Thank you.
No problem. Thank you, Siddharth. Glad you were here.
Rahul, I have another question about mortgage
Yes, sir.
renewals. So, I've recently heard that there is no more the requirement for stress test at renewals, right?
Yes.
But does that also mean that there will be no income verification at the time of renewals?
No, they will still verify your income. They would just not use the stress test to qualify you based on your income. And that only depends if you're changing lenders. Because if you're with the existing lender, they again don't do any stress test for renewal. So let's say you're with CIBC and you want to renew your mortgage with CIBC. You just tell them I'm going in for a renewal. They won't ask you for any income documents. You won't have to prove your income again. You just get a straight refinance. If you're changing lenders, if you're changing banks, let's say going from CIBC to TD or Scotia, then those banks have to qualify you based on your income again, but they can let go of the stress tests.
Got it. Got it. Thank you.
No problem.
Rahul, I want to ask a question.
Yeah.
So I saw in your data, townhouses are getting too much appreciation. Do you recommend townhouses as a investment?
Yeah. Again, any house type doesn't make a good or a bad investment. It all depends on the neighborhood. If you're in a solid neighborhood where everything's growing and in your budget you could only get a townhouse, that's fine. You don't have to wait till you get a detached or a semi-detached. Um, so get whatever is in your budget, but select the neighborhood very carefully because that's where your potential to refinance, your potential to grow, even in the worst case scenarios, if you want to upsize, you want to sell and upsize, everything will depend on the appreciation.
Sounds good.
Okay, Dhruv has a question. Can you share average mortgage interest rates? Yeah, absolutely. That is what Tuesday. I think just Friday, we had somebody who got a mortgage rate of below 3.89, which was a very good rate, uh, on a less than 20% down mortgage. For somebody with a 20% down, I think last week we were able to secure just below 4 again, 3.95 for them. And all these rates are from A lenders. So
Yeah.
I see the credit score up there as well. Honestly, if your credit score is over 670, 700, there's not a major change in the interest rates. Like you won't, banks won't give you a 3.6 from a 4%. You'll stay within that range. It just depends on how much you qualify for. The rates and your credit score. Once your score goes beyond 670, it's not a major difference.
Okay. And one other question would be the 3.8 or something which you mentioned. Is it the fixed or is it variable?
Sorry, I missed that. Yeah, that's a fixed rate for 3 years.
Okay. And would you recommend going for fixed rates because the mortgage rates are coming down right now?
I
So,
would recommend based on like what plans do we have for the next 3, 5, 10 years. Well, sorry. If you're looking to maybe do the refinance trick or maybe leverage out the money the next 1, 2 years, I would go variable as of now because March we have another rate cut. This year, everybody, even RBC, TD, Scotia, everybody has uh, it's recommended they'll drop the rates down by 0.75 to 1%. So even if you get a variable rate of 4.6, 4.7 today, it might be better than the current fixed rate by end of 2025.
okay. And if suppose we are planning to buy a house right now, flip it in the next 4 years, 5 years per se. in that situation, the variable would be the best way to go.
Yes, I would still say variable for now, as of today. Just try it out for next 6, 7, 8 months. If the rates are getting lower, we stick to variable. If we feel the market's getting steady or the rates are not going down as we expect, you always have one option to convert your variable to fixed rate at any given point of time during your tenure of 3 or 5 years. So you can take that option even after you've originally taken a variable rate.
Okay, perfect. Thank you.
No problem. All right, we'll complete in an hour. See, some people are dropping off. Anand's gone. I hope you had a good session. Anybody has any questions, more than happy to stay back and answer. If not, you'll get an email with all our details, all our guides, a lot of paperwork in there, which we've created very specifically with a lot of thought behind it. Go through that. Any recommendations to improve those things, we are more than happy to accommodate that as well. But thank you everybody for being here. It was a pleasure. Thank you, Richa. Thank you, Karan. Thank you, Dhruv. Good to see you. Thank you, Roy. I'm glad you were here.
Yeah, it's a bit different for us because we're based in Montreal. I was just gonna say, like having to find a property in Toronto and all that. We started off with one and we're still holding out and trying to figure out when we're ever going to break even. You talked about how condo prices have gone down, in like North York. So, like, what's your prediction now? Like, if you're thinking about you got 2 more years left on the mortgage and it's fixed, like, what do you see in terms of that particular market, especially for people like us?
Yeah, absolutely. So the pockets for North Yorks I shared were Bayview and Willowdale West, but we are at a certain different pocket. That pocket is still holding steady. Uh, I think the location will have an important aspect in terms of the selling price, but we still have 2 years mortgage left on that. The rent's coming in steady. I would say hold on for the next 2 years. Let ride the market fluctuation. By 2027, the market will shift aggressively. If you're able to uh, get slightly positive cash flow because of lower interest rates, great. If not, we'll try to see if we can use that equity or use that uh, savings that we've created in that condo to move to a townhouse with a lower maintenance fee or no maintenance fee, so we can increase our cash flow and refinancing potential down the future.
Okay, that's great. So moving to a townhouse could be an option like down the line.
Absolutely. So every condo we purchase for all of our investors or our clients, every condo we purchase are only short terms. Like you look at condos for like 5, 7 years max. If it's just a stepping stone into the Toronto's market. As soon as the growth starts coming in, we let go of the condo, use that money, put towards a townhouse, and then again we get into a better cash flow situation because there's no maintenance fee.
Okay, okay. And would you recommend actually going back to renegotiate like the rates, like considering that interest rates are dropping, or would you say wait till when you're closer to the end of your term? Because we still got about a year before we have 1 year left to renegotiate like the terms in terms of the interest that you could get on it.
Yeah, it depends. Because usually banks will charge you a penalty. But in a situation where they are able to let go of the penalty, we can renegotiate even 2 years, 2.5, 3 years before the renewal. So I would say it's worth giving a shot, talking to your bank, uh, see if they can let go of that penalty and get us a lower rate. Even if they're charging penalty, but if a monthly savings or yearly saving or the rest of the savings for the term are better than the penalty, then we can look into that as well.
Okay, okay, that's great. Thanks a lot, Rahul.
No problem. Glad you were here. Next time we'll throw in some Montreal data as well.
Absolutely. But thanks a lot. Appreciate it.
Thank you. Thank you, everyone. If anybody's any questions, I'll hold on for another minute. If not, but I will say thank you for being here. Means a lot.
Rahul, I do have one more question about the mortgages.
Sure.
The mortgage amount that you can get an approval for depends on your income, right? So if you have or if you're already invested in one property and well, I understand the equity would grow, there would still be the remaining loan amount, right?
Yes.
How would you how does it work that you'd be able to take on more debt or get approved for another mortgage for a new property?
Yeah,
Because
no,
you're in
great question. So that's why these rental incomes come into picture. Let's say for the first house, for the example we showed, we created an additional basement rental potential from that house. So when we moved on to the other house, the bank used the rent from the first house as our income. So we were able to get that income, and also with time, you grow, your skills grow, you get better job profiles, so your mortgage approvals keeps getting better, and these rental incomes just gives you a push in terms of getting some more mortgages so you can invest higher.
Okay. I was just curious because I was wondering whether the underlying asset value of the house also somehow factors in.
Absolutely.
So, okay, that helps answer my question. Thank you.
No problem. Because the underlying housing value is basically that's how the banks will decide if how much money you can pull out of the house. So that 80% that they finance is based on the current housing value. So yes, these components do come into picture. Houses should have to go up in value, and also your income will eventually get better with time. So you're able to qualify for more mortgage, and then we add the rental income on top of your income to supplement that additional mortgage requirement for the banks.
Thank you. I appreciate that.
Perfect. Anybody else? Any questions? All right. So that's it. Thank you, everybody. It was a pleasure. See you in the next webinar. We'll try to keep doing these with different topics this year. Great to see you all here. Take care. Have a great night. Bye-bye.
Right night. Have a good night. Thank you, Raul.
Thank you. Bye-bye.
Thanks,
Thanks,
Rahul.
Rahul.